Trying to make sense of market swings? Well, it can feel like being tossed around in a storm of data sometimes, can't it?
Absolutely.
So many trading indicators promise clarity, but uh, often they just add to the confusion. What if you could cut through all that noise
hmm
and grasp the underlying market momentum with the same precision as, seasoned professionals?
That's exactly what we're aiming for today.
Great. We're taking a deep dive into using the Relative Strength Index, or RSI, specifically for analyzing the Nifty 50 index.
Yep.
Our goal here is to equip you with a professional-grade, multi-time frame approach to really understanding this key indicator.
Exactly. And the RSI, it's a go-to tool for a lot of pros because it gives you a pretty clear snapshot. It shows the speed, the force, really, behind price movement.
Like a speedometer for the market.
That's a great analogy, yeah. A market speedometer. It gives us readings from 0 to 100. And we pay really close attention to that 70 mark.
Go ahead.
That often suggests the market might be getting a bit overheated, what we call overbought.
Overbought, right?
And then there's the 30 level, which can indicate that selling pressure might be, exhausted, leading to oversold conditions.
Okay, so the RSI basically helps us gauge if the Nifty 50's recent moves are likely to stick around or if maybe a reversal is coming.
Precisely. And what's particularly powerful about the way professionals use it, and what we'll unpack in this deep dive, is looking at the RSI across different time frames.
Right, not just one chart.
Exactly. From the really broad monthly view all the way down to the more immediate hourly chart.
We'll break down a structured step-by-step technique,
Yeah.
and we'll use some hypothetical examples too, just to make it really clear how you can apply this in your own analysis.
Absolutely. And, to really grasp how pros use the RSI, it helps to know a little bit about its foundation.
Okay.
The formula is basically RSI equals 100 minus 100 divided by 1 plus RS. Now, RS itself is the average gain over a period divided by the average loss over that same period.
Right, the math is there, but the core idea is momentum, comparing gains and losses.
That's the key takeaway, yes. It's measuring momentum by comparing those average gains and losses.
Okay, and for the time frames, we'll be looking at hourly, 4-hour, daily, weekly, monthly. What's the standard setting? The period for the RSI calculation to keep things consistent.
Yeah, good question. For a meaningful comparison of momentum across all those different views, we stick with the widely used 14-period setting.
14 periods, okay.
Yeah, that lets us assess momentum on a comparable basis, whether we're looking at short-term hourly blips or the big long-term monthly picture.
Right, 14 periods it is across
Right.
the board. Now, let's circle back to those key levels, 70 and 30 you mentioned. What are the practical implications when the RSI hits those zones?
Okay, so when the RSI climbs up above 70, it signals that the recent buying pressure has been pretty strong, maybe potentially too strong, like unsustainable. It doesn't mean the price will drop immediately, but it's a suggestion, a heads up that the market might be due for a pause or maybe even a reversal.
So look out for potential selling opportunities then.
Potentially, yeah, especially when you combine it with other confirming signals. And conversely, an RSI dipping below 30, that indicates strong selling pressure that might just be reaching its limit.
Oversold territory.
Exactly. It could suggest the market's oversold and maybe a bounce or an upward correction is coming. So that prompts us to look for potential buying opportunities.
So hitting those extremes is like a warning light flashing. What about when the RSI is just sort of floating in the middle?
Well, that area between, say, 40 and 60 on the RSI scale is often seen as a neutral zone.
Okay.
Readings there generally suggest the current trend might just keep going, without huge momentum either way. Or maybe the market's consolidating, taking a breather before the next move.
And the 50 line, the exact middle.
The 50 level. That's pretty key, too. If the RSI consistently stays above 50, it often points to an overall bullish sentiment in that specific time frame. Buyers are generally in control.
Makes sense.
And if it's consistently below 50, well, that points to a bearish bias. Sellers have the upper hand.
Okay, these levels give us a basic framework for understanding momentum on any given chart. Now, how do we actually get this onto our Nifty 50 charts?
Right. You'll definitely need a charting platform. Popular ones, really effective ones include TradingView, MetaTrader, Zerodha Kite is another big one.
Right.
These platforms let you easily add the RSI indicator to your Nifty 50 chart. You just search for the Nifty 50 ticker symbol. Usually that's NSEI.
NSEI, got it.
And then look for the option to add the relative strength index indicator. It's usually pretty straightforward.
Okay, platform open, Nifty chart is up, RSI added. Now, let's get into this multi-time frame approach. Why is this so valuable for professional traders looking at the RSI? What's the real benefit of looking at the big picture first?
Yeah, this is where it gets really insightful. Starting with that higher level view, like the monthly and weekly charts, helps us nail down the dominant market direction. And importantly, it helps filter out the short-term noise.
Ah, the noise that can cause false signals.
Exactly. Those little wiggles on the lower time frames can often lead you astray. So, by identifying the big trend first, we can then use the shorter time frames, daily, 4 hour, 1 hour, to find more precise moments to get in and out of trades.
Okay.
But crucially, those trades align with the broader direction. It's like planning a trip, right? You figure out your destination and the main highway before you start worrying about specific exit ramps.
That makes perfect sense. So let's start at the top. The monthly time frame. What are we trying to figure out from the RSI on this really long-term chart?
The main goal looking at the monthly RSI is to identify the Nifty 50's long-term dominant trend. Is it generally bullish, bearish, or just stuck in a range?
Okay.
The process is simple. Plot the 14-period RSI on the monthly chart. Then look, is it mostly above or below that key 50 level? That gives us the long-term bias.
Right. Bullish above 50, bearish below.
Yep. We also note if the RSI is getting near or has hit overbought above 70 or oversold below 30, those can suggest potential long-term turning points. And finally, crucially, we look for divergences.
Divergences. Okay. What's that exactly?
A bearish divergence, for instance, is when the Nifty price makes a new higher high, but the monthly RSI fails to make a new higher high. It suggests that the long-term upward momentum might be weakening.
Gotcha. So price is going up, but the momentum isn't keeping pace.
Exactly.
Yeah.
Can you give us a hypothetical example? What might we see on a monthly chart and how would we read it?
Sure. Let's imagine the Nifty 50 is trading around, say, 25,000. And on the monthly chart, the 14-period RSI is reading 65.
Okay, 65, above 50.
Right. So the key insight is the long-term trend is bullish. But because it's getting up towards 70, we should be aware, the market might be getting a bit stretched in the long run.
A bit overextended.
Yeah. Now, if we also see that both the price and the RSI have been making higher highs consistently over recent months, then there's no immediate bearish divergence to fret about.
Okay.
So our takeaway would be, long-term trend is bullish, but that RSI nearing 70 suggests maybe we should focus on buying pullbacks on the lower time frames rather than chasing rallies that might be running out of steam.
Okay, that paints a clear picture for the monthly view. Now let's zoom in a bit to the weekly time frame. What's the purpose of looking at the RSI here?
The weekly time frame, it really serves to confirm that long-term trend we saw in the monthly. And it helps us spot potential medium-term opportunities.
Okay, confirming the monthly.
Yeah. Just like before, plot the 14-period RSI, but this time on the weekly chart. The key is seeing if the weekly RSI action supports the monthly outlook.
So if the monthly was bullish,
We look for bullish signals on the weekly too. For example, maybe the RSI crosses above 40 that can show strengthening bullish momentum in the medium term. Or if it crosses below 60, that might suggest increasing bearish momentum.
interesting those 40 and 60 levels again.
Yeah, they act like intermediate zones. And
Okay.
just like the monthly, we keep an eye out for divergences or if the RSI is hitting overbought oversold on the weekly time frame.
Let's continue our hypothetical example then. What might the weekly RSI show us?
Okay, let's say the Nifty has pulled back just a tiny bit, maybe to 24,800, and the weekly RSI is at 60, but it's trending upwards.
Okay, 60 and rising.
This aligns pretty well with our bullish view from the monthly chart, right? The RSI is above 50 and rising, suggesting intermediate-term momentum is also turning more positive.
And it's not overbought yet.
Right, still below 70, so no weekly overbought signal. And let's assume no significant bearish divergence either. The insight here is that the intermediate trend supports the overall long-term bullishness. That gives us more confidence, to look for entries on the daily or lower time frames.
Right, the higher time frames are giving us the green light.
Exactly. We have a higher degree of confidence in those potential buy signals lower down because they're backed by the weekly and monthly trends.
Got it. Now down to the daily time frame. This is where things get more tactical, right? How do we use the RSI here?
Yeah, the daily is where we start getting more specific about potential entry and exit points, but always keeping in mind that broader bullish context from the monthly and weekly. So again, 14-period RSI on the daily chart. Here, we're specifically looking for signals that harmonize with those higher time frame trends. So in a bullish scenario, we might look for chances to buy when the daily RSI dips down into that 40 to 50 zone.
Ah, buying the dip in an uptrend.
Exactly. It could represent a temporary pullback within the bigger uptrend, potentially offering a lower risk entry. We'd also watch for the RSI crossing back above 50. That can signal the pullback might be over and bullish momentum is picking up again.
Okay.
And of course, still watching for divergences or extremes. A dip below 30 on the daily in an overall bullish market, that could be a particularly attractive buy opportunity.
So back to our example, what would the daily RSI be telling us?
Let's say the Nifty's had a short-term dip to 24,700, and the daily RSI is now sitting at 45.
Okay, 45, in that 40-50 zone.
Yep. Given our bullish monthly and weekly analysis, this suggests a potential buying opportunity might be forming. Let's also assume no bearish divergence on the daily, and the price is still well above a key longer-term support, like maybe the 200-day moving average way down to 23,500.
Okay, context looks good.
So the insight is that this daily pullback might be losing steam. We should be getting ready for a potential entry. We'd probably look for some confirmation, though.
Like what?
Like the RSI moving back above 50, maybe? Or the price breaking above a recent short-term high before we actually pull the trigger on a trade.
Okay, so we're getting closer to a potential trade. Now we move to the 4-hour time frame. What's our focus with the RSI at this level? Intraday stuff.
Exactly. The 4-hour time frame is really about pinpointing more precise intraday entry points, but still making sure they align with that daily trend we just established.
Right.
Plot the 14-period RSI again. Since our higher time frames are bullish, we're primarily looking for RSI signals showing upward momentum here. Ideally, the RSI holding above 50.
Okay.
We can also use RSI divergences or maybe overbought, oversold readings on the 4-hour chart to spot potential short-term reversals, little bounces or dips we might want to trade, as long as they fit the bigger bullish picture.
And combining with support and resistance here.
Oh, definitely. It's often really beneficial to combine these 4-hour RSI signals with key support and resistance levels that we can clearly see on the 4-hour chart itself. Adds confluence.
So continuing our scenario, what might we see on the 4-hour?
Imagine the Nifty has edged down a bit more, maybe to 24,650.
Yeah.
And the 4-hour RSI has dipped to 42.
Okay, 42. Getting close to oversold territory on this time frame.
Right. And in the context of our bullish daily trend, this suggests a short-term bounce might be coming soon. Now, if we also notice that the price is nearing a support level around 24,600 that we spotted on this 4-hour chart.
Ah, confluence again.
Exactly. That adds more weight. The insight here is this could be a good zone to look for a buy, in line with the higher time frames. We might wait for, say, the RSI to cross back above 50, and maybe the price to break above a minor recent high, perhaps 24,700, as a trigger.
A signal that upward momentum is returning on this intraday time frame.
Precisely.
Okay, and finally we zoom right in, the 1-hour time frame. This is for the really precise timing, yeah? Entries and exits.
That's the idea. The 1 hour is our tool for high-precision timing, still analyzing the 14-period RSI, and our main focus is finding signals that are perfectly in sync with the trends on the 4-hour and daily charts.
Got it.
So in our ongoing bullish case, we might look for the 1-hour RSI to dip into that 40-50 range and then show clear signs of turning back up. An RSI breaking above 50 on this time frame. That can be a very timely trigger for a long entry.
Okay.
We also look for RSI breakouts, maybe drawing little trend lines on the RSI indicator itself and watching for a break, or for divergence patterns on this very short-term chart that support the direction from higher up.
And candlesticks, you mentioned combining tools.
Absolutely. Combining these RSI signals with specific candlestick patterns, reversals, continuations, especially when they pop up at key support or resistance levels we found on higher time frames, that can give you very high probability entry points.
So putting it all together in our example, what specific entry signal might we be watching for on the 1-hour chart?
Okay, let's say the Nifty is now at 24,670. The 1-hour RSI has risen to 48, bouncing nicely from a recent low of 40.
Okay, showing some strength.
Yeah, this upward move aligns with the potential buy signal we were seeing on the 4-hour. Now, what if we also spot a bullish engulfing candlestick pattern forming right at a minor support level, maybe around 24,660?
Bullish engulfing at support. That's a classic.
It is. So the insight here is this the rising RSI, the bullish candle pattern, right at support that could be our signal. Enter long around 24,680.
And the stop loss.
Crucial. Place the stop loss order just below that support level, say below 24,600, to manage the risk effectively if it doesn't work out.
This step-by-step multi-time frame approach using the RSI is really illuminating. But you mentioned earlier, professionals don't just use the RSI in a vacuum. What other key tools do they often combine it with?
Yeah, that's a crucial point for, really effective analysis. The RSI gets even more powerful when you use it with other forms of technical analysis.
Like what?
Well, for instance, identifying key support and resistance levels. That can help validate RSI signals. If you see an oversold RSI reading happening right at a major support level for the Nifty, maybe 24,500.
That strengthens the buy case, right?
Hugely. It strengthens the case for a potential buy. Similarly, moving averages like the 50 period and 200 period help confirm the overall trend direction. Price above both, generally bullish, makes bullish RSI signals more reliable.
Okay, moving averages, support resistance. What else?
Candlestick patterns are incredibly useful too. Spotting a bullish reversal pattern, like that bullish engulfing we mentioned, or a hammer forming at the same time the RSI is showing oversold, that can be a very strong hint of a potential trend reversal.
And volume. Does volume play a part?
Definitely. Paying attention to trading volume adds another layer of confirmation. If you see higher than average volume during an RSI breakout, like when it crosses above 50,
It adds conviction to the move.
exactly. It can add conviction to the strength of that upward move.
Can you give a quick example? How might all these things come together?
Sure. Imagine the daily RSI for Nifty is at 45. Suggests a possible pullback in an uptrend, right?
Okay.
Now, let's say Nifty is trading around 24,700, which happens to be very close to its rising 50-day moving average, maybe at 24,300.
Okay, near a key MA.
And on this particular day, we see higher than average trading volume. And right at that moving average level, a bullish hammer candlestick forms.
Ah, okay. Multiple signals lining up.
Precisely. You've got the RSI in a potential buy zone, price finding support at a key moving average, increased volume showing buying interest, and a bullish reversal candle. That combination creates a very strong buy signal, gives you much higher confidence in a potential up move.
Right, having multiple things aligning definitely boosts conviction. Now, beyond just the basic overbought, oversold levels, what other specific RSI signals, maybe patterns on the RSI chart itself, should we look for?
Yeah, there's several other important signals and patterns that experienced traders keep an eye on. We've talked about overbought, oversold. Beyond that, divergences are key.
Where price and RSI tell different stories.
Exactly. A bullish divergence. Price makes a lower low, but the RSI makes a higher low. Can signal that the downtrend might be losing steam, maybe an upward reversal is possible.
And bearish divergence is the opposite.
Opposite. Price makes a higher high, but the RSI makes a lower high. That can warn you about weakening momentum in an uptrend. Potential trouble ahead.
Okay, divergences. What else?
Another useful technique is drawing trend lines directly on the RSI indicator itself.
On the RSI line, not the price chart.
Correct. Sometimes a breakout of an RSI trend line can actually happen before a significant move in the price. It's like an early warning.
Interesting.
And lastly, there are failure swings, bullish and bearish.
Failure swings.
Yeah. A bullish failure swing happens when the RSI dips below 30, but then it rises back above a previous reaction high within the RSI indicator, without the price making a new low. It can be a strong sign of renewed upward momentum.
Okay. And bearish.
Bearish failure swing is the mirror image. RSI goes above 70, then falls back below a previous reaction low in the RSI without the price managing to make a new high. Suggests potential downside pressure building up.
These more advanced signals definitely add another layer. It sounds like recognizing these consistently just comes from, well, practice and watching the charts carefully.
Absolutely. Getting familiar with these patterns, seeing how they play out in different market conditions,
Yeah.
that's key to using them effectively in your trading.
Okay, so we have a good handle on the RSI, using it across time frames, combining it with other tools. Now, how do we put all this together? How do we synthesize it into a concrete, actionable trading plan?
Right. Developing a really well-defined trading plan is absolutely essential. You can't just wing it.
No doubt.
When you're using RSI in this multi-time frame way, your entry rules need to be super specific. For instance, you might decide, I will only consider a long trade if the RSI crosses above 50 on the 1 hour or 4 hour chart, and only if the daily and weekly RSIs are bullish and the price is near clear support.
Very precise rules.
Exactly. And your short rules would be the mirror image. You also need to know, before you enter, where your stop loss goes.
Absolutely critical.
For a buy, typically just below a recent swing low. Protects your capital if it goes wrong. For a sell, just above a recent swing high.
And take profit targets.
Same deal. Have clear targets in mind beforehand, often based on significant resistance levels for buys or support levels for sells. And critically, always consider the risk-reward ratio.
Aiming for more profit than risk.
Yeah, a good rule of thumb is at least 1 to 2. Risking 1 unit to potentially make 2 makes trading mathematically viable long-term.
And position sizing. How much capital to risk?
Paramount for risk management. Only risk a small, predefined percentage of your total trading capital on any single trade. A common range is like 1% to 2%.
So on a 1 lakh rupee account?
You'd risk maybe 1,000 to 2,000 per trade. Keeps you in the game, even if you hit a losing streak.
Sound risk management, always the foundation. Now, once we've built this plan using RSI and multi-time frame analysis, how do we know if it actually works before risking real money?
That leads us to a really crucial stage. Backtesting.
Testing it on historical data.
Exactly. Before you trade live, you need to test your strategy rigorously using historical Nifty 50 price data. Most charting platforms have tools for this.
Okay.
So you'd go back in time, find every instance where your entry criteria were met, maybe 1 hour RSI crossed above 50, while the daily RSI was above 50.
Yeah.
You simulate taking the trade, track how it would have performed based on your stop loss, and take profit rules.
And you do this many times.
Many times. Over a significant historical period. This lets you gather objective data, your win rate, average profit, average loss, maximum drawdown, which is the biggest dip your simulated account took.
So you get real numbers on how the strategy performed historically.
Exactly. And based on those results, you refine your rules. Maybe you find using 35 and 65 for RSI levels works better than 30/70 for the Nifty sometimes. Or maybe adding another indicator, like Mansi, as confirmation improves results. It's an iterative process.
Test, analyze, adjust.
Test, analyze, adjust. Optimize your plan based on evidence.
So it's definitely not a set it and forget it kind of thing. It needs ongoing work.
No way. The market's always changing, evolving. Your strategies need to be robust, adaptable. Backtesting gives you the data to make informed tweaks.
Okay, we've backtested, refined. We have a plan we feel good about. Now, when we're actively trading, how do we monitor these RSI signals across all the time frames in real time and make adjustments on the fly?
Right, real-time monitoring means regularly checking the RSI readings on all the time frames in your strategy. You might look at the monthly and weekly RSIs maybe once a week just to check the big picture trend hasn't drastically changed.
Okay, big picture check weekly.
Then probably daily. You'd monitor the daily and 4-hour RSIs for potential trade setups aligning with those longer trends.
Looking for opportunities.
Yeah. And finally, you'd use the 1-hour RSI for the actual timing entries and exits when your higher time frame conditions are met.
And adapting to market conditions, like volatility.
Crucial. You need to be ready to adapt. A good gauge for Nifty volatility is the VIX index.
The India VIX.
Yeah. During high volatility periods, say VIX is up above 20, things are jumpy, you might need to widen your stop losses a bit to avoid getting stopped up by noise, or maybe even adjust your RSI levels, use 20 and 80 for extremes, because RSI can stay pegged for longer in volatile markets.
And in low volatility, VIX below 12 maybe.
Then you might do the opposite. Tighten your stops, maybe revert to the standard 30/70 RSI levels because moves are less extreme.
So the market's volatility level actually influences how we interpret RSI and manage trades.
Precisely. It's all about context, understanding the environment the RSI signals are appearing in, and adjusting your tactics to manage risk effectively in that environment.
Let's bring this all together then. Can we walk through a practical example? Use some hypothetical Nifty data, say from May 16th, 2025. Show us a potential trade based on everything we've discussed.
Okay, great idea. Let's imagine on May 16th, 2025, the Nifty 50 showed these RSI readings. Monthly RSI was at 62.
Bullish long term.
Weekly RSI was 58.
Also bullish, showing upward momentum.
Daily RSI had pulled back to 44.
Okay, temporary pullback in the uptrend.
4-hour RSI dipped to 42.
Nearing oversold on the intraday.
And the 1-hour RSI was at 46, but it was starting to move up from a recent low of 40.
Okay, showing some immediate upward movement.
Right, so the big picture from monthly weekly,
Right.
bullish. The daily pullback, RSI 44, suggests a potential buy the dip opportunity.
In the lower time frames.
The 4-hour near oversold, 42, and the 1-hour starting to rise, 46, give us a potential short-term entry signal, lining up with that bigger trend. Now, let's say Nifty is trading around 24,715, and we see its near recent support at 24,700. And crucially, a bullish pin bar candlestick just formed on the 1-hour chart.
The confluence again. Higher time frame bullish, pullback, RSI turning up, price at support, bullish candle.
Exactly. That whole combination presents a pretty compelling long trade setup. So we might decide enter long at 24,720.
Stop loss.
Just below that support, say 24,690. That's a 30-point risk.
Kick profit.
Aim for the next significant resistance level, maybe around 24,840. That gives us a potential reward of 120 points.
So 120 points reward for 30 points risk. That's 1 to 4 risk reward. Very good.
Excellent risk reward. And if you were trading with that 1,000 account, risking 1%, that 30-point risk would dictate your position size. Then if Nifty does rise to our target of 24,840, maybe the 1-hour RSI hits 68 or something, we exit the position, take the profit.
That detailed walkthrough really solidifies how all the pieces fit together in a practical scenario.
Excellent.
Now, as we wrap up, what are some final key tips, the takeaways for using RSI like a seasoned pro?
Okay, a few crucial ones to remember. First, always prioritize trading with the higher time frame trend. Avoid counter-trend trades based only on lower time frame RSI signals. It's usually fighting a losing battle.
Don't swim against the current.
Exactly.
Yeah.
Second, be cautious with divergences. Yes, they're powerful, but always look for confirmation from price action or volume before acting. Minimizes false signals.
Information is key.
Third, remember, in strong trending markets, RSI can stay overbought or oversold for ages. Don't just automatically sell because RSI hit 70 in a strong uptrend or buy because it hit 30 in a strong downtrend. Context matters.
Right.
Fourth, consistently apply the multi-time frame approach. Higher time frames for trend, lower time frames for setups and entries. Be systematic.
Discipline.
And finally, absolutely non-negotiable. Always manage your risk. Use stop losses. Aim for a positive risk-reward on every single trade.
Invaluable insights. This deep dive into using RSI with a multi-time frame approach for the Nifty 50 has been, well, incredibly insightful. It's clear that mastering this isn't just glancing at a number, it's about understanding context, strategy, discipline.
Exactly. By integrating this kind of structured, multi-time frame RSI analysis into your toolkit, you really can move beyond just basic interpretations and get a much more sophisticated understanding of market momentum.
So here's a final thought for you, the listener, to chew on. Consider how incorporating this multi-timeframe RSI method could really give you a more nuanced perspective on market momentum, taking you way beyond just simple overbought, oversold signals.
And maybe think about what other technical indicators, when you combine them with this RSI approach, might sharpen your analysis even further in different kinds of market conditions. It really is all about continuous learning, isn't it? And refining how you see the market move.